The Philippines posts a record high of $10.5 billion in net inflows of foreign direct investments last year.
To digital transformation, information communications technology, infrastructure, to logistics. And they're all here to pursue deals that will strengthen two-way trade and investment between the United States and the Philippines.
To Secretary Gina Raimundo and the entire U.S. Presidential Trade and Investment Mission for mutual economic progress of both nations and further strengthen our partnership across all areas.
Money Talks and the Philippines is listening. Foreign investors have their eyes and wallets on the Philippines, pouring in $8.6 billion in net foreign direct investment FDI in the first 11 months of 2024. That's a 4.4% jump year on year, proving the country remains a hotspot for global capital. Backed by investments from Japan, the US, the UK, and Singapore, sectors like manufacturing, real estate, and retail are thriving. But not all signs point to smooth sailing. November's inflow took a sharp 19.8% dive, raising questions about whether this momentum is built to last. Is this just a momentary dip or the start of a shifting investment landscape? With net inflows of $8.6 billion between January and November 2024, foreign direct investment, FDI, in the Philippines is still growing. This represents a 4.4% year-over-year growth, indicating that investor confidence has held steady in spite of global economic challenges. Major economies like Japan, the US, the UK, and Singapore continue to pour capital into the country, targeting manufacturing, real estate, and retail, sectors that underpin economic expansion. This surge reflects strong market fundamentals, a growing consumer base, and the government's ongoing infrastructure push. The Philippines' resiliency and appeal as an investment destination are highlighted by the positive FDI performance. The nation is demonstrating its potential to compete in the region with the help of strategic economic policies and a stable business environment. But with November's 19.8% decline in FDI inflow, it begs the question of whether this momentum can continue or if a slowdown is imminent. Foreign investors continue to see the Philippines as a prime destination, with Japan, the United Kingdom, the United States, and Singapore leading the charge in foreign direct investment, FDI, from January to November 2024. These nations are fueling key industries, from manufacturing to real estate, solidifying the country's role as an economic powerhouse in Southeast Asia. Japan remains a dominant investor, channeling capital into manufacturing and infrastructure projects, strengthening industrial development and supply chain networks. With strong ties in automotive and electronics production, Japanese firms continue to expand their footprint in the country. The United Kingdom is making its mark in real estate and finance, taking advantage of the Philippines' rapid urbanization and growing middle class. British investors are actively involved in property development, commercial leasing, and financial services, further integrating the country into global financial markets. The United States continues to pour investments into technology, retail, and business process outsourcing, BPO, sectors where the Philippines holds a competitive edge. With a highly skilled workforce and a thriving digital economy, U.S. companies see strong, long-term potential in expanding their operations. Singapore, a regional investment hub, plays a crucial role in retail, logistics, and fintech, leveraging the Philippines' digital transformation. With the country's booming e-commerce sector and increasing demand for financial technology solutions, Singaporean investors are capitalizing on emerging opportunities. The diversification of FDI sources highlights the Philippines' broad international appeal, demonstrating that investor confidence is not reliant on a single market. This balanced portfolio strengthens economic resilience and reduces dependency on any one country, positioning the Philippines for sustained growth in the years to come. Foreign direct investment, FDI, in the Philippines is not just growing, it's being strategically allocated to sectors that drive long-term economic expansion. From January to November 2024, the bulk of FDI inflows went into manufacturing, real estate, and wholesale and retail trade, reflecting investor confidence in the country's economic fundamentals. Manufacturing remains a top recipient of FDI, attracting investments from Japan, the US, and other key players. Capital is flowing into electronics, automotive, and food processing, strengthening the Philippines' role in global supply chains. This sector's expansion means more jobs, technology transfer, and increased exports, boosting the country's industrial competitiveness. With rapid urbanization and infrastructure development, foreign investors are actively investing in commercial, residential, and industrial properties. The growing demand for office spaces, logistics hubs, and mixed-use developments is making real estate a prime target for FDI, particularly from the UK and Singapore, which have strong interests in property investments. The concentration of FDI in these sectors highlights strategic growth areas that align with the Philippines' economic priorities. By strengthening its manufacturing base, urban infrastructure, and retail industry, the country is laying the groundwork for sustainable economic expansion, creating a ripple effect that benefits businesses, workers, and consumers alike. The Philippines had a substantial dip in foreign direct investment, FDI inflows in November, with net FDI equal to $901 million, a 19.8% year-over-year decline, despite a solid overall performance in 2024. This sudden decline begs the question of whether it is a short-term setback or a symptom of a larger trend. Several factors could explain this slowdown. Global economic uncertainties, tighter monetary policies in major economies, and geopolitical tensions may have led investors to pause or reassess their capital allocations. Domestic factors such as regulatory adjustments or investor caution ahead of policy shifts may have played a role. While November's decline is notable, the overall FDI performance from January to November remains positive, with a 4.4% year-over-year increase to $8.6 billion. This suggests that while there may be short-term fluctuations, investor confidence in the Philippine economy remains intact. The key question now is whether this dip is an early warning of a slowdown or just a seasonal adjustment. The next few months will be critical in determining if FDI inflows can regain momentum, or if external and internal pressures will weigh on investor sentiment. For now, the Philippines remains a strong investment hub, but careful monitoring is needed to assess what's ahead. While total FDI inflows for January to November 2024 showed positive growth, a closer look at November's investment breakdown reveals significant declines in key areas, indicating potential shifts in foreign investor strategies. Foreign investors channeled $791 million into debt instruments, such as intercompany loans and bond issuances, marking a 17.9% year-on-year decline. This suggests that while parent companies still support their Philippine subsidiaries, they may be exercising more caution, possibly due to global interest rate hikes or a reassessment of capital allocation. One of the most striking figures is the 58.9% drop in fresh equity capital, with non-residents injecting only $35 million in November. This sharp decline may reflect heightened investor risk perception, concerns over regulatory changes, or shifting priorities toward more liquid assets rather than long-term ownership stakes. At $74 million, the reinvestment of earnings stayed rather consistent, in contrast to the decline in new investments. Despite the decline in new capital inflows, this shows that businesses that are already doing business in the Philippines have faith in the market and prefer to reinvest their profits rather than send them home. The declines in debt instruments and equity capital contrast with the overall FDI increase of 4.4% for the year, hinting at potential shifts in investment strategies. Investors may be hedging risks, waiting for clearer economic signals, or shifting focus toward reinvestment rather than new entries. While the long-term outlook remains positive, these trends highlight the need for continued investor-friendly policies and economic stability to sustain momentum in 2025 and beyond. The 4.4% growth in net FDI inflows for January to November 2024, reaching $8.6 billion, signals continued investor confidence in the Philippine economy. However, the sharp dip in November's figures and the decline in non-residents' net investments in debt and equity capital raise questions about potential headwinds. Here's a closer look at the implications and future outlook.
As we go along our development journey, I invite all of you to continue and enhance that partnership. When you think growth, think Philippines, so that together we will reap the benefits of robust, sustainable, and inclusive growth for our businesses and for our peoples. Let's make it happen in the Philippines.
Despite a nearly 20% year-over-year drop in November's foreign direct investment, the overall increase in foreign capital inflows suggests that the Philippines remains a preferred investment destination. The strong focus on manufacturing, real estate, and wholesale retail trade highlights sectors that are driving economic expansion and job creation. However, the decline in new equity investments raises concerns. Are investors becoming more cautious, or are they waiting for clearer signals before committing more capital? The $901 million net FDI inflow in November represents a sharp decline from the previous year, which could stem from multiple factors. Global economic uncertainties, tighter monetary policies in major economies, and shifting trade dynamics may have made investors more selective. Additionally, potential domestic factors, such as evolving regulations or political developments, could be shaping investor sentiment. Foreign investors are betting big on manufacturing, real estate, and retail, reflecting confidence in the Philippines' consumer-driven growth and industrial expansion. Manufacturing, especially in electronics and automotive, strengthens the country's role in global supply chains. Real estate investments signal optimism in urbanization, while retail growth highlights strong consumer demand. However, the sharp decline in new equity capital suggests new investors are proceeding with caution. Foreign investment in debt instruments dropped 17.9% year over year, while new equity capital collapsed by nearly 59%, raising concerns about shifting investor strategies. Are they retreating due to global financial uncertainty or reallocating funds to safer assets? Despite the slowdown, reinvested earnings, $74 million, remained stable, indicating that companies already operating in the Philippines still see long-term growth potential. The Philippines' FDI trajectory in 2025 and beyond will depend on three key factors. Global interest rates, higher rates in the US and Europe could divert capital from emerging markets. Geopolitical tensions, regional conflicts, and trade disruptions may impact investment flows. Domestic reforms, investor-friendly policies, infrastructure upgrades, and ease of doing business will be critical in sustaining FDI. The Philippines is still a desirable place to invest despite immediate difficulties. Bold economic policies and robust steps to boost investor confidence will be crucial to keeping the momentum going. The net FDI influx of $8.6 billion from January to November 2024, which represents a 4.4% annual rise, demonstrates the foreign investors' ongoing faith in the Philippine economy. The investment landscape is nevertheless vibrant and attractive, with manufacturing, real estate, and retail trade as important recipient sectors, and Japan, the United Kingdom, the United States, and Singapore as prominent sources. Nonetheless, significant concerns are raised by the 19.8% decrease in November's FDI inflows, as well as the dip in non-residents' net debt and equity capital investments. The decrease in new capital infusions indicates a more cautious approach to investment, which may be impacted by changes in the global economy, changes in interest rates, or conditions in the Philippine market, even while corporations reinvesting earnings in the country indicate persistent optimism. It is essential to keep an eye on these investment trends in order to evaluate the state and trajectory of the Philippine economy. To ensure that the nation continues to be a top destination for foreign capital in a global market that is becoming more and more competitive, FDI growth will need to be sustained by aggressive policies, stable regulations, and planned economic reforms. Thank you for tuning into our channel. If you enjoyed the video, please remember to like, share it with your friends, and subscribe to our channel for more in-depth analysis of global issues.